You've spent years chasing the perfect strategy, studying charts till 3 a.m., backtesting, tweaking, hoping. But deep down, a question haunts you. If I'm working so hard, why am I still stuck? The truth is harsh. Most traders don't fail because they're dumb, lazy, or unskilled. They fail because they're built to win, not to survive. And when the storm hits, guess who's still standing? Not the smartest, not the fastest, but the one who prepared for disaster long before it came. This video isn't about how to win bigger trades. It's about how to not get wiped out when the market turns into a monster. Welcome to the psychology of professional hedging, where the game isn't about being right, it's about staying alive. Imagine a trader. He's sitting in front of 6 glowing screens, eyes red, fingers twitching, heart pounding. His position just went red, fast. The market didn't even blink. Should I close it? Should I hedge? Please, just give me one more chance. He opens the hedge, not because he had a plan, but because fear whispered louder than logic. He didn't hedge. He panicked. And this, right here, is where 90% of retail traders lose the game before it ever starts. You see, we were all taught to treat hedging like a last resort, a fire extinguisher you grab when the whole room is burning, a desperate move when hope is gone. But what if that mindset is exactly what's killing your edge? What if hedging isn't supposed to be a panic button, but a power tool? Not a sign of failure, but a mark of foresight. The professionals, they think differently. They don't hedge when fear shows up. They hedge long before that. Cold, calculated, calm. They hedge the way a pilot checks emergency fuel before takeoff, not because he expects to crash, but because he respects the sky. That's the difference. Retail hedges emotionally. Professionals hedge structurally. Let me ask you something personal. Have you ever opened a hedge just to avoid closing a losing position? Just so you wouldn't feel the sting of being wrong? Be honest, because if you have, you weren't hedging. You were preserving ego, not capital. You turned a risk management tool into a psychological escape hatch. Think of it like driving. Do you wear a seatbelt because you plan to crash? No. You wear it because uncertainty is part of the road. Same with hedging. You don't use it because you're expecting failure. You use it because you've accepted that no one controls the road, not even you. 2 traders, same setup, same entry. But one has a hedge plan, a rule that says, if price moves 50 pips against me, I trigger a counter position, not to escape, but to reduce exposure while I reassess. The other, he watches in horror as the market tanks, panics, opens a hedge, then another, then forgets why he entered the first trade at all. He's stuck in a psychological spiral, not a strategy. One trader uses hedging to buy clarity. The other uses it to buy time and ends up paying with his sanity. Here's the uncomfortable truth no trading guru will tell you. Control is an illusion. But structure is real. And hedging, true hedging, isn't about emotion. It's about architecture. It's about building systems that survive impact, like engineers designing a skyscraper to sway with the wind, not fight it. So let's redefine it. Hedging is not weakness. It's not fear. It's not indecision. Hedging is dominion over chaos. It's you saying, I don't know where the market will go, but I know where I stand. And when done correctly, it changes everything. It removes panic. It injects pause. It creates space between you and the storm. Now imagine this. Before you enter your next trade, you already know the exact price that triggers your hedge, the size of the hedge, the rules for exiting both legs, your margin exposure, your mental limits. Now that is no longer gambling. That's architecture. That's trading like a designer, not a reactor. Here's what most traders never realize. The market doesn't punish you for being wrong. It punishes you for being unprepared. You could be right 30% of the time and still come out rich if you survive. And survival doesn't come from talent. It comes from systems that absorb pain without breaking. So the next time your trade goes south, before your hands shake, before you whisper, just one more chance, ask yourself, am I hedging or hiding? If it's hiding, stop. If it's hedging, execute, because now you know the difference. Let's pull back the curtain. Forget theories. Forget instincts. Forget emotions. Let's talk numbers. Because once you understand the math behind hedging, it stops being mysterious and starts being mechanical. And mechanical means repeatable. And repeatable, that means survivable. Picture this. You're walking across a frozen lake. The surface looks solid, but with every step, the ice creaks louder. You can't see where the cracks are, you just know they're there, somewhere. Do you keep walking in hope, or do you spread your arms to balance, maybe carry a rope, wear gear? That instinct, that balance reflex, that's hedging in its purest form. It doesn't guarantee safety, but it gives you a fighting chance. So let's break hedging down to its most basic definition. Hedging is opposing exposure. If you're long one asset, if you're going to open a short on the same asset or a correlated one. Simple, elegant. But here's where it breaks down for most traders. They do this. Price drops, panic, open hedge, same size, then freeze. Now what? They're stuck. Their original trade is bleeding. Their hedge is helping, but not enough. No plan, no direction, no edge. They didn't hedge, they trapped themselves. And here's the trap. Most traders think hedging is about not losing, but true hedging, strategic hedging, is about regaining control. Because if you don't know how to exit a hedge, you're not trading. You're just surviving in limbo. That's why traders say hedging doesn't work. It's not that hedging failed, it's they had no exit architecture. And that's where the math comes in. Let me introduce you to the most life-saving, account-saving formula I've ever seen, the 1.5x hedge rule. And it's so simple, it fits on a napkin. Here's how it works. Let's say your initial position is down $100. Instead of opening a hedge of the same size, you open a hedge that's 1.5x the size of the original trade. Why? Because you're not just trying to neutralize the loss, you're trying to reverse the damage. Think of it like falling into a 10-foot hole. You don't need a 10-foot ladder to climb out. You need a 15-foot ladder so you can get above ground level again. Same with trading. You're not trying to cancel the loss. You're trying to exit with dignity, even profit. Let's run numbers. You go long one lot of EURs USD. Price drops 20 pips. You're down $200. Instead of closing, you open a short of 1.5 lots. Now, if price drops another 20 pips, your original long loses $200 more, but your hedge gains $300. Net result plus $100. You turned a painful spiral into a strategic pivot. Now you're thinking, what if the market snaps back the other way? That's the key. You don't hold both legs forever. You define an exit corridor, what I call a hedge zone. It's a price range where your goal isn't to win. It's to recover, breathe, reassess. Here's a basic blueprint. You open a buy on GBP USD at 1.3 thousand. Stop loss is 129.8 drew. If price hits 129.80, you open a sell hedge at 1 size, set sell target to recover your loss plus small profit. If price returns to 13,000, your original entry, you close both positions. Now, you're no longer betting on direction. You're navigating a safety corridor, a zone where your job is to stay alive and stay clear-headed. So let's recap what you've just learned. Hedging is not about escape. It's about structure. The 1.5x rule creates recovery leverage. You use math, not hope, to create an exit window. You stop trading with panic and start trading with precision. I once met a trader who'd been profitable for 20 years. His secret? Not a dozen indicators, not a paid signal group, just 3 rules written on an index card. If I'm down 2%, hedge at 1.5x size. If the hedge recovers original loss, close everything. Never stack more than 3 hedges. That was it. Simple math, applied ruthlessly. Survival wasn't optional, it was engineered. Here's the truth. Markets are wild. Strategies will fail. News will shake you. But if you build your foundation on structure over emotion, you'll stop fearing the next red candle because you'll already know what to do. You won't react. You'll execute. It's 2:08 a.m. The market spikes without warning. Red flashes across your screen. But this time, you don't panic. You don't freeze. You don't close. You don't curse the sky or beg the chart gods. Why? Because you've already built the blueprint. You're not reacting. You're executing. Most traders try to invent a system in the middle of chaos, but that's like building a parachute after you've jumped. A hedge without a system is like a recipe without measurements. Looks good in theory, useless in real life. That's why we're going to build one. Together, right here, right now. And by the time we're done, you'll have a hedge system that does 2 things. Protects you in real time, frees your brain from emotional decision making, because systems don't get scared. This isn't about being clever, it's about being consistent. A good hedge system isn't complicated, it's clear, repeatable, boring even. But boring is good when money's on the line. Let's get to work. The 6 essential elements of a hedge system. These 6 pieces form the spine of your blueprint. Miss one, and the whole thing collapses. 1. Entry trigger. What starts the trade? No more gut feelings. You need a rule, a price level, a chart pattern, an indicator crossover, a news-based trigger. Write it down. Define it. Because if your entry isn't clear, your exit never will be. 2. Hedge trigger. When do you hedge? This is your alarm system. And then a fixed loss percentage, a pip amount, a time-based failsafe. Example, if trade is down 2% or 25 pips, initiate hedge at 1.5x size. This stops you from hedging emotionally. You're not guessing, you're responding to rules. 3. Size logic. How big is your hedge? We covered this in part 2. Use the 1.5x rule as a base. If you risk $100, hedge to cover $150. If price drops further, your hedge gains more than your trade loses. If price reverses, you exit clean, but decide in advance. Will your hedges always be 1.5x? Will you scale them? Keep it simple and sustainable. 4. Exit rules. When do you close both positions? This is where 90% of hedge strategies fail, because without exit rules, hedges become prisons. So define: close when the hedge profits equal original loss, close when price returns to entry, close on major news reversal. The rule doesn't have to be perfect, it just has to be clear. 5. Emergency break. Your red line. How many hedge layers will you allow? Because every hedge uses margin. Every hedge locks capital. And too many, that's a slow motion margin death spiral. Most pros limit it to 3 to 5 layers. Define your max and stick to it. More on this in a moment. 6. Timing filters. When not to trade or hedge. There are moments when the best hedge is no trade at all. Examples: high impact news, FOMC, NFP, Brexit, during sleep hours, when volatility spikes or spreads widen, before holidays or market close. Ask yourself, would I want to be in this hedge if the platform froze for an hour? If the answer is no, skip the trade. Let's talk about why hedge limits matter, because this is where even seasoned traders go broke. The margin death spiral. Imagine this. Bitcoin crashes from $58,000 to $30,000. You're using a grid bot. It keeps hedging every 1% drop. No cap. By the 12th level, you've got 5 BTC worth of counter trades. Your margin? Tapped out. Then liquidation. Game over. And the worst part? You were right on direction eventually, but you never made it there. You died from overhedging. Pre-calculate your survival. Ask yourself, how much margin will I use after 2 hedges? After 3? After 5? Where is my account death point? If you don't know, you're flying blind. Know your survival numbers before you enter the first trade. Here's what nobody tells you. Even perfect hedges bleed quietly. Why? Spread costs on every entry, swap fees for overnight positions, funding rates in crypto up to 0.1% every 8 hours, lost opportunity cost of locked margin. I've seen traders hold a hedge for 2 weeks. P&L showed break even, but after swaps, down 20%. The hedge protected nothing. It just bled them dry. Your emergency brake system. Build this like a fire exit plan. Rule 1, max 3 to 5 hedge layers, pick your number. Rule 2, if margin usage hits 50%, no new hedges. Rule 3, time limit. If unresolved after X days, exit. Rule 4, always account for 20% hidden cost buffer. Take your last losing trade. Now imagine you had this system. Go back. Apply the 6 rules. Run the numbers. Would you have survived? Would your loss have been smaller? Would your head have been clearer? This is not about perfection. It's about direction. Start here. Your mini mission. Define just 2 rules. Your hedge trigger, your max hedge layers. Comment them below this video. I'll personally review some. Remember, your system doesn't need to be perfect. It just needs to exist. Professionals don't build systems to feel smart. They build systems to survive. They don't trust willpower. They trust frameworks, because at 2 a.m., when the market moves fast, your mind will forget. But your system will remember for you. June 23rd, 2016. The world was watching. Brexit referendum results were trickling in. The polls predicted Remain. The markets were calm. Traders slept soundly. But one woman in Malaysia didn't. She wasn't trying to outsmart the news. She didn't have insider info. She didn't make a bold prediction. She simply respected uncertainty. So instead of choosing a side, she opened both a long and short on GBP USD. 1 lot long, 1.5 lots short, just in case. When the results hit, the pound collapsed over 1,300 pips in hours. Her long was crushed, but her short, it ran nearly 1,000 pips deep into profit. While Reddit lit up with margin call horror stories, she cashed out calmly, almost mechanically. She didn't hedge to win, she hedged to survive. And survival in this business is everything. But not every trader had her discipline. Same year, same event, different mindset. Another trader saw the pound crashing and opened a panic hedge at the very bottom. Then another and another. No plan, no exit, just pain. The pound bounced hard. Now both positions were bleeding. He closed everything for a massive loss. He wasn't beaten by the market. He was beaten by his own psychology. The psychology traps that kill hedge traders. Let's strip away the charts. Forget the math for a moment, because the most dangerous weapon in trading is your own mind. These are the three psychological traps that sabotage even well-designed hedge systems. One, the emotional hedge. You're in a losing trade. You can't bear to close it. Your ego won't let go, so you hedge, not to protect, but to delay the pain. Now you're stuck, frozen. You don't know which side to close. Your system is out the window. You're just watching numbers bounce, praying. That's not hedging. That's emotional paralysis with a price tag. Two, the revenge hedge. You get stopped out. You're angry. You jump into the opposite direction, this time with double the size. No setup, no confirmation, just revenge. But the market doesn't care about your anger, and before you realize it, you're down on both sides. Again. Three, the overconfidence trap. This one's the trickiest because it hides behind a mask of logic. You've built a hedge system. You've done the math. You feel untouchable, so you break your own rules. You add a fourth hedge when your limit is 3. You ignore the margin usage. You start trading your system like it's smarter than the market. But overconfidence is hubris in disguise, and the market loves to humble hubris. Let me tell you a story I don't usually share. Years ago, I had a hedge run for 3 days straight. Price was dancing in between. Spreads were widening, swaps were bleeding, neither side was winning. I was stuck. Logically, I knew what to do. Close both legs, take the small loss, move on. But I couldn't. I told myself, just a little more, it might turn. Eventually, I closed out exhausted, and of course, minutes later, the market ripped in my original direction. I could have held on and won, but that wasn't bad luck. That was bad psychology. The 3 questions that save your trading. Before you place a hedge, ask yourself, is this part of my plan or am I running from pain? Can I handle the worst case scenario emotionally? Am I hedging the position or my ego? If you hesitate answering any of these, you shouldn't hedge. Simple as that. The pre-mortem exercise. Before you enter your next trade, I want you to mentally rehearse disaster. Ask yourself, can I handle watching a hedge draw down before it works? Can I close both legs at break even after hours of mental pressure? Will I respect my own max layers rule when layer 5 is underwater? Or will I whisper, this time is different, and blow up everything? Because the best hedge traders aren't calm because they feel safe. They're calm because they've already accepted what could go wrong. They've rehearsed it, and they've built a system to survive it. Think back to your worst trading loss, the one that still stings. Ask yourself, if I had a hedge system, emotionally neutral, mathematically sound, how different would that day have been? Don't just think money. Think about the confidence you lost, the sleep you missed, the time it took to recover, the fear that lingers every time you enter a trade now. That's what this is about. This isn't about making more money. It's about losing less of yourself along the way. So far, we've built the system. Now we've confronted the shadow that lives inside every trader. In the next chapter, we explore something most people never even consider. What if your system is perfect, but your broker blocks your trades? That's right. Your platform, your country's laws, your broker's fine print, they can kill your hedge plan before you even place a trade. Let's pull back the curtain on regulatory traps, hidden platform rules, and the brokers that quietly destroy survival systems. Imagine this. You've done everything right. Tested your hedge rules, built your blueprint, logged into your trading account, finally ready to go live. You place your first hedge, and then a warning flashes. Hedging not permitted. Position netted. Your long and short positions cancel each other out. Your carefully designed system, dead on arrival. Welcome to the invisible battlefield of trading, where traders lose not because they lack skill, but because they didn't know the rules of the arena. The regulatory reality, especially in the US. Let's say you're a US-based trader. You've probably heard of FIFO, first in, first out. Sounds harmless, right? But here's what it means in practice. If you're long one lot of year USD at 1.1000 and then try to short 1.5 lots at 1.0950, your broker will automatically close your original long to fulfill the FIFO rule. Why? Because the National Futures Association, NFA, says so. You can't hedge on most US platforms, not because of your broker, but because of the law. This rule is designed to protect traders, but in reality, it destroys hedging strategies completely. So, what are your options? Option 1, use an offshore broker. Many traders opt to use brokers outside the US in jurisdictions that allow full hedging. Popular names include IC Markets, Pepperstone, FX Pro, 8cap. With these brokers, you can go long and short the same instrument at the same time with full control. But there's a trade-off, the offshore dilemma. Offshore doesn't mean unsafe, but it does mean less protection. No SIP-C insurance, harder to recover funds if the broker disappears, less oversight from major regulatory bodies. Some are registered in places like Seychelles or Vanuatu, not exactly financial fortresses. So before you go offshore, ask yourself, if this broker went dark tomorrow, how would I get my money back? Always test first. Start small. Watch how deposits and withdrawals work. Read real trader reviews, not sponsored fluff. Option 2, hedge with correlated pairs. Can't hedge EUR/USD directly? Go long EUR/USD and short GBP/USD. They're correlated. It's not perfect, but it's a proxy hedge, and in some cases, it's enough to manage directional risk. This trick lets you stay compliant with US rules while still protecting exposure. Option 3, use options instead of spot rent. If your broker blocks spot hedging, consider trading options. With options, you can stay long the asset, buy a put for downside protection, or sell a call to collect premium hit. Options give you control over risk without violating hedging restrictions. Platforms like Thinkorswim and Tastytrade don't allow direct spot hedging, but offer powerful options tools. Learn them. Master one setup, and suddenly the rules become a playground instead of a prison. Let's talk platforms. Even if your broker allows hedging, the platform itself might not. Here's the breakdown. MetaTrader 4FEF, MT4, MT5, supports hedging, clear visual of both long and short, only if your broker allows it. Crypto exchanges, Binance, Bybit, OKX, most allow hedging through futures. But beware, funding fees every 8 hours, spread slippage during volatility, liquidation risk with leverage. Use hedge mode, set limits, monitor funding rates. In crypto, fees can bleed your hedge faster than the trade itself. US brokers, Thinkorswim, Tastytrade, Charles Schwab. No direct spot hedging. Options and synthetic structures allowed. If you're a US-based trader using one of these, your best bet is to learn options or trade correlated assets. A trader once emailed me in frustration. He spent months building a flawless hedge system, back-tested, optimized, beautiful. He funded his live account with $10,000. First trade, blocked. Why? He never checked if his broker allowed hedging. One overlooked setting cost him everything. Pre-flight checklist. Before you fund a broker, does this broker explicitly allow hedging? What are the margin requirements for hedged positions? Is it regulated somewhere meaningful? ASIC, FCA, SISEC? What happens to your funds if they go under? Have you tested the platform with small positions first? The tax bomb nobody talks about. Here's a curveball. In some countries, each leg of a hedge is taxed individually. And what does that happen? Even if your net P&L is zero. Imagine this. You hedge 100 times, win $5,000 on one side, lose $5,000 on the other. Break even, right? Wrong. You owe tax on the winning side. And now you're paying real money on phantom profits. One trader told me he made 500 hedge trades, broke even in the end, paid $2,000 in tax prep fees. Hidden costs of free brokers, that zero commission broker, they're not doing you favors. They profit through wider spreads, payment for order flow, you get worse fills, interest on your idle funds, strategic restrictions, no hedging, no scalping. Always remember, if you're not paying with money, you're paying with execution. Quick test. Do this tonight. Open a demo account. Try placing both a long and a short on the same pair. What happens? Do they open separately? Good. Do they net into one position? Red flag. Does the platform reject the order? You need a new broker. Do not wait until real money is on the line. You can have the best hedge system in the world. But if your platform blocks it, your strategy is just theory. And in trading, theory without execution is death. Coming up next, Now that you understand the hidden limitations, we're going to pull back the curtain on how institutions use hedging. Big firms like Goldman Sachs, JP Morgan, Bridgewater, they hedge everything, but not out of fear, out of long-term discipline. And once you see how they think, you'll realize this game isn't about getting rich quick. It's about staying in the game long enough to let compound skill work. When you think of hedging, you might picture a desperate move, a backup plan, a last-ditch effort to save a failing trade. But for the titans of finance, Goldman Sachs, JP Morgan, Bridgewater, hedging is the first move. It's not panic, it's precision. They don't hedge because they're scared. They hedge because they plan to be here for the next 10, 20, 50 years. That's the difference. Retail traders hedge to stop the bleeding. Institutions hedge to keep the heart beating before the cut ever happens. The institutional truth. It's not about being right. This will sting. Institutions don't aim to be right all the time. They aim to stay solvent. That's the game. You can be right 30% of the time and still be rich if you don't die first. Let that sink in. Bridgewater's legendary all-weather portfolio is built entirely around this truth. The all-weather blueprint. Ray Dalio's genius. Dalio didn't try to guess the market. He tried to respect the unknown. Here's how he hedged entire economic cycles. Long stocks for growth, long bonds for deflation, long commodities for inflation, long gold for crisis. He wasn't predicting, he was preparing. No matter what happened, booms, busts, pandemics, part of his portfolio always had a reason to survive. Retail traders think, how can I win this trade? Institutions think, how can I not lose everything when I'm wrong? The Susquehanna secret, poker before profits. At Susquehanna, one of the world's largest proprietary trading firms, new hires don't start with charts. They don't touch markets. They play poker, board games, simulations. Why? Because they're learning risk, not money. The first lesson isn't about signals or setups. It's how do you survive a bad hand without blowing your stack? Imagine if every retail trader started there. The Swiss Army knife, options as insurance. Let's get tactical. Imagine this. You're long Ethereum at $2,000. You're bullish, but nervous. The market's shaky. Most retail traders either hold and hope or hedge with a short position. But pros, they buy a put option at $1,800. That gives them the right, not the obligation, to sell ETH at $1,800 no matter how low it goes. ETH crashes to $1,000, that put explodes in value, cushioning the fall. ETH rallies to $3,000, you still make money, minus the cost of the option. It's insurance. You hope it expires worthless, but you sleep better knowing it's there. The straddle strategy, betting on movement, not direction. Institutions don't always bet on direction. Sometimes they bet on volatility itself. The straddle strategy, buy a call and a put at the same strike. You win if price moves big in either direction. You only lose if price stays flat. Perfect for earnings reports, Fed announcements, elections, war rumors, black swans. You're not predicting the wave. You're just ready to ride whichever one comes first. The basis trade, free money in crypto. In crypto, futures often trade at a premium to spot. So institutions buy Bitcoin at $50,000. Spot, sell Bitcoin futures at $51,000. They lock in a $1,000 profit regardless of price movement. Boring? Yes, but boring pays bills. They do this all day, every day. Small edge, big capital, infinite repetition. That's the real grind. Which tool for which problem? Let's simplify. Options, when you want to protect downside but keep upside. Futures, when harvesting structural differences. Correlated pairs, when direct hedging is blocked. CFDs, when you need flexible sizing and fast execution. The mistake? Trying to master all of them at once. Institutions don't do that. They master one weapon and use it with discipline. From individual trades to portfolio architecture, retail traders think in trades. Institutions think in architecture. Here's what that looks like. Your portfolio: tech stocks, a growth bet; Bitcoin, a risk-on bet; gold, a crisis hedge; oil, an inflation hedge; EUR/USD, a dollar weakness play. Looks diversified? It's not. If the Fed raises interest rates unexpectedly, everything crashes together. You didn't have 5 trades, you had one idea expressed 5 ways. That's not hedging, that's correlation death. Real diversification means opposite movement. True institutional hedging means holding assets that react differently to the same event. If stocks crash, what rises? volatility, bonds sometimes, US dollar, defensive sectors. This is how you create a portfolio that doesn't crumble all at once. That's the real hedge. The 80-20 survival model. Here's a simple structure: 80% core strategy, 20% crisis hedge. Rebalance quarterly. Not sexy. Not flashy, but powerful. You won't double your account in a month, but you'll sleep at night. That's the institutional edge. Uh, when I learned this, everything changed. I stopped asking, how can I make the most, and started asking, how can I lose the least when I'm wrong? That shift, that's where professionals are born. You've seen how the giants play this game. But now, what if your system could think like them? What if your hedge rules executed themselves instantly, unemotionally, without hesitation? What if you didn't have to be present, but your system was always on guard? Imagine this. The market drops 3% in 5 minutes. News hits. Volatility spikes. Panic sets in. You're getting coffee. Because back at your desk, your system isn't panicking, it's executing. Your bot has already calculated exposure drift, opened a counter position, adjusted size using the 1.5x rule, set the exit parameters, checked your hedge limits, all while you're not even watching. That's the automated edge. Humans break rules. Bots don't. Let's be honest. You can have the best trading plan in the world, but the moment real money is on the line, you hesitate, you hold too long, you skip the hedge, you override the stop, you chase a reversal. Automation isn't about being a genius coder. It's about being human enough to know your limits and smart enough to design systems that protect you from them. The simple framework that works. Mofanish. Here's a basic automated hedging rule. If trade is down 2% from entry, open hedge at 1.5x size, set TP at original loss amount. If both positions flat, close all, max hedge layers 3. That's it. 5 rules. You could write them on a napkin. But if you code this or use a visual builder, you've created a mini hedge engine. Not flashy, not sexy, but durable. Platforms for beginners. You don't need to be a programmer. Seriously. Here are tools you can start with. TradingView with PineScript, great for backtesting, visual interface, easy to get started, huge support community. 3 commas, drag and drop logic, connects to crypto exchanges, beginner friendly, perfect for if-then automation. MetaTrader 4.5 with expert advisors, more complex, but insanely powerful. Many free templates exist. Pick one. Don't learn all 3. Simplicity scales, complexity explodes. The 3 deadly automation mistakes. 1. The complexity trap. I'll just add this extra filter and this trailing exit and this adaptive grid. Stop. Simple systems are more robust. The more conditions you add, the more things that can break. A bot doesn't need to be clever. It needs to be reliable. 2. Set and forget fantasy. A bot is not a magic ATM. Markets change, spreads widen, fees rise, volatility shifts. What worked last year might wreck your account this year. You must monitor, update, and evolve the system. Automation is not a one-time build, it's a living process. 3. The override problem. Your bot is running fine, then the market moves. Fear kicks in, you override it manually. Boom, now you have the worst of both worlds, a broken system and a scared trader. The entire point of automation is to escape your own impulses. Override it too often and you defeat the purpose. Kill switches that save accounts. Smart traders install brakes. So should you. Here are your emergency stops. Max daily loss, magnitude 2%, shut down. Max trades per day, 10. Halt. Margin usage, 50%, pause all entries. Spread widening beyond average, temporary shutdown. These are fail-safes. They won't make you profits. They'll keep you in the game, and in trading, survival is the only prerequisite for long-term success. My first automated hedge bot, it was beautiful. Clean code, great logic, backtested to the moon. In live markets, it blew up in 2 days. Why? I forgot to factor in spread widening during news events. The bot kept opening and closing trades every few seconds, bleeding slowly through slippage and fees. It wasn't a bad system. It was a bad assumption. That's the lesson. Don't test it once. Test it in chaos. Portfolio correlation, automation's secret weapon. Hedging isn't just about single trades. It's about portfolio protection. When markets crash, correlation spikes. Everything moves together. Your automation system should track correlation. Here's how. Build a spreadsheet of daily percent changes for all positions. If correlation goes above 70%, increase hedge. If correlation falls, reduce hedge. Simple logic. Massive impact. The cash hedge, boring but brilliant. Sometimes the best hedge is holding cash. Build your system to automatically reduce exposure when volatility rises or correlation spikes. Even just 20% in cash gives you the firepower to buy when others panic. Not sexy, but it's the kind of boring that makes you rich long term. Automation homework. Write like a 5-year-old. Take your simplest hedge rule. Now write it as if explaining to a child. Open quote. If price drops this much, do this. Then wait. If price goes back, stop. If both sides are even, close both. Close quote. That level of clarity, that's what you need before automating anything. No vague logic, no fuzzy signals, pure action, pure rules. You've now taken the leap from manual control to systematic survival. And here's the truth. Automation doesn't make you perfect. It makes you consistent. It doesn't eliminate risk. It controls your response to risk. And when you can control your response, you win the long game. But there's one final level. What if your system could learn, adapt, evolve, think faster than any human? What if you could build a strategy so intelligent you tell it how you feel and it does the rest? That's not the future. That's now. There's a quiet revolution happening behind the charts. While most traders are still arguing about indicators and candlestick patterns, the giants have already moved on. They're not just using algorithms, they're using AI. Not someday, today. Goldman Sachs, JP Morgan, Renaissance, they don't just watch the markets, they train systems that study them, evolve with them, and hedge in ways no human mind ever could. AI doesn't guess, it recognizes. Machine learning models can analyze millions of trades, detect behavioral anomalies in price action, react to order flow in milliseconds, adjust hedge positions in real time, predict risk spikes based on social sentiment, not just price. It's not just math, it's pattern recognition on a scale our minds were never built to handle. They don't ask, open quote, what's the trend? Close quote. They ask, open quote, what's about to go wrong, and how do I survive it before it starts? Close quote. Time compression, the unfair advantage. Here's where it gets wild. What takes a trader years to learn, an AI can absorb in hours. Every market crash, every recovery, every hedge mistake, it can simulate and learn from them all. It doesn't need to feel pain to learn. It just needs data, and data is unlimited. That's why hedge funds are building quantum models. That's why banks are hiring neuroscientists and mathematicians instead of traders. Because the game isn't about better entries anymore. It's about smarter risk decisions, faster, sharper, cold. The core truth that never changes. Now, before we get lost in the tech, let's bring it back. Because no matter how advanced our tools get, one thing will never change. Open quote. Every trade still comes down to one question. What are you trying to achieve? Close quote. Survival, growth, peace of mind. Tools evolve. Platforms change, but principles don't. The best traders from 50 years ago would still win today. Why? Not because they had the fastest internet, not because they had bots, but because they understood these three truths. Protect your downside, let winners run, survive first, thrive second. That's timeless, and even AI can't replace that. It can only amplify it. Your 3-step action plan knowledge without execution is just entertainment. So here's your simple call to arms. Step 1, comment your breakthrough. What hit hardest? The psychology traps, the 1.5x hedge math, options as insurance, platform pitfalls? Share it, because what clicks for you today might save someone else tomorrow. This is a game we survive together or fall alone. Step 2, design one rule, just one. Write a hedge rule based on everything you've learned. Open quote, if trade is down X%, open hedge at Y size. Close all if flat. Max Z layers, close quote. That's it. Not perfect, just real. Post it, get feedback, improve it. Iteration beats imagination. Step 3, grab your tools. Don't wait. In the video description, grab the free hedge system blueprint, position sizing calculators, example rule sets, margin requirement tables, PDF guides. No email, no paywall, just tools to help you survive the next storm. The choice ahead. Every trader now faces 2 doors. Door A, you close this video, you tell yourself you'll figure it out next time. You keep playing the game raw, no armor, no edge, and you hope the next crash doesn't take you out. Door B, you start building your hedge system. You apply one rule on demo if needed. You test, tweak, iterate, and trade knowing you've already priced in chaos. Black swans will come. You will be wrong again. There will be flash crashes, there will be unexpected news, There will be a day when everything you predicted turns out false. But this time, you won't lose everything. You'll take hits, but not knockouts. Lose battles, but win wars, because you didn't build for glory. You built for durability. This is bigger than trading. This is about more than charts. It's about the kind of person you become when you prepare for storms instead of pretending they won't come. It's about the confidence you carry because you've built something that lasts. It's about waking up to volatility and not flinching. That's not trading. That's freedom. Final pattern interrupt. Every major fund, every institution, every professional worth their salt, they all hedge, not because they're weak, but because they plan to be here in 10, 20, 50 years. Do you? This is Psychology of Profit. Trade the plan, manage the risk, survive the storm. I'll see you in the next video.